Over the past month, the market has been under a lot of pressure. The S&P 500 is down 4%, Nasdaq down 3%, and Dow Jones down 3.5%. Inflation remains high, interest rates are not declining, and having attractive bond returns has caused some downward pressure onto the stocks. At the end of the week, we had a decent job report that caused a small bounce, but not enough for a full recovery. This causes the greed and fear index to go from 18, which is extreme fear, to 25, which is fear. Investors are still fearful due to the nature of uncertainty and better opportunities outside the stock market. Despite having certain underliers in the green, we can see that the market overall is in the red for the month period. Now, being a dividend investor, we like to find opportunities in every dip. And while this is a small dip, we can attempt to find the best options on where to invest our money. So I will be going through 3 companies despite being in the red year to date due to market fluctuations. They have a specific situation that made them go lower. Disclaimer, I do own the companies that will be mentioned, and this is not investing advice, just me sharing my views for educational purpose only. Let's dive in. Number 1 will be Hershey's. This is a cash flow generating stable company. What I like about Hershey's is that it's a predictable, simple business that sells chocolate and salty snacks. Over the last decade, the company has been generating over 9.5% in net income. When you look at other consumer defensive companies, you can see that Hershey's doubles or triples their net income growth in the last decade. So for me, Hershey's is a top-tier consumer defensive company. Looking at the free cash flow, we can see the same trend like the net income, a growing free cash flow with a flat stock-based compensation. So we know that Hershey's do make money, so that should be reflected at the stock price, right? Well, Hershey's is currently down 14% year to date and it's been dropping since May. This is way before the recent stock market drop. So what could happen here? We have to go back to their latest earnings report, where in a specific section, they stated the following. Capital expenditures of approximately $800 million to $850 million driven by confection capacity expansion and continued investments in digital infrastructures including ERP systems. Right now, Hershey's capex is around $500 million, so it's increasing by $300 million. This means that the future free cash flow will momentarily be less. I believe investors overreacted to this, as the capital expenditure is being used for preparations in capacity, probably for their high season, which is in October. Chocolate will be in demand for Halloween. Next, upgrades to their ERP, which is a software system that helps you run your entire business, supporting automation and process in finance, human resource manufacturing, procurement, and more. So Hershey's is going down because free cash flow is being lower. That's it. The fundamentals of the company look intact for me, and I will continue to buy. I do not see any other red flag that could put this company or its shareholders in trouble. Next up, we have Clorox, another consumer defensive company. The EBITDA of this company is down heavily, the same situation with the net income. Now, when we look at the free cash flow, it does not look so bad. Taking a quick glance at the price of the stock over the last 5 years, we can see that Clorox has dropped heavily, especially from their pandemic high, when their products were needed. Same as other companies, Clorox went down in price, but something in particular happened with this company a few weeks back. So let's summarize. The Clorox company has released a preliminary financial information for the first quarter fiscal of 2024, ending in September 30, 2023. The company's net sales are expected to decrease significantly, between 23 and 28%, compared to the same period last year due to the impact of a recent cybersecurity attack. Organic sales are also expected to decline by 21 to 26%, in contrast to previous expectations of mid-single-digit growth. The cyber attack disrupted Clorox operations, causing delays in order processing and product shortage. Gross margin is anticipated to be down from previous year, primarily due to the cybersecurity attack's negative effects, including lower cost absorption. The earnings per share are expected to range from a loss of 35 to 75 cents, and adjusted EPS is projected to be a loss of 0 to 40 cents. Clorox expects ongoing operational impacts in the second quarter but anticipates a gradual return to normal operations and the restocking of retailer inventories. The company is still assessing the long-term impact of the cybersecurity attack on fiscal year 2024 and will provide an updated outlook during its first quarter earnings call in November. In terms of operations, Clorox believes the cybersecurity attack is contained and it has started transitioning back to automated order processing, which should help increase the output and shipments to rebuild retailer inventories over time. So this is why their fundamentals seem more down than the usual. The Clorox company is beaten down, and it could be a buying opportunity for those who would like to add a slow growth defensive company to their portfolio. Next, we have Realty Income. Realty Income Corporation and Blackstone Real Estate Income Trust have entered into a definitive agreement to create a joint venture to acquire 95% interest in the real estate assets of the Bellagio, Las Vegas. Realty Income will invest around $950 million in this venture, with approximately $300 million in common equity, giving them a 21.9% indirect interest in the property. Blackstone will retain a 73.1% indirect interest, and MGM Resorts International will keep a 5% stake in the property. Realty Income will also invest $650 million in a yield-bearing preferred equity interest in the joint venture. So we know how real estate operates. They need to pay 90% of their income to shareholders. So in order to do this type of acquisition, they have to increase the shares outstanding to raise cash. Also, by interest rates remaining high, it causes some disturbance in the performance of REITs. Higher interest rates tend to decrease the value of properties and increase REITs' borrowing cost. In the long term, we know interest rates won't remain high, and the Bellagio stake will bring additional income to Realty. So there you have it, the 3 companies that I believe are oversold due to their particular situation and that can pose a buying opportunity to some investors. Before closing this video, I want to make a special mention to Coca-Cola and Pepsi. The 2 beverage giants are down 16 and 10% respectively year to date. For me, it's not common to see both companies being down this much, so I will keep an eye on them and maybe add a tranche or 2, especially for KO since it's less than 2% of my portfolio. So that will be it for this video. Thanks for watching, subscribe, and I'll see you in the next one.